We have seen a number of defaults in the China private sector market so far this year in 2018. And this has basically been the result of two developments in the market. So basically the Chinese government has been clamping down on leverage in the economy. And they also been basically wanting to introduce more market-based pricing and allowing more and more defaults as part of that. But it should be noted that even taking these defaults into consideration, the China onshore market has a lower default rate than is the case in the States. So for the China onshore market, you have a default rate of 0.4% this year, and that compares to 2.5% for the US high yield market. So yields has basically increased in China on the back of this, as investors have been repricing the risk of investing in credit because they have seen that the government is now letting more companies default. But it should be noted that the spread widening we have seen seems to be more related to this liquidity squeeze and not so much to fundamentals. Because if you look back to the equity crisis in China in 2015-16, when you had spreads on a similar level, what you saw back then is that the companies were a lot more levered than what they are today. So basically, since then they have been cleaning up their balance sheets and delevering, so they're actually better off and in a better financial position right now. In the credit market, we don't think that they would really want a big default wave in the private sector. Why is that? Let's take a step back here. This is to do with basically the overarching goal of the Chinese party. So what they want is stability in the economy and stability in the labor markets. And that objective is not really met if you have a wave of defaults, with a lot of layoffs that would potentially cause social unrest, etc. And that the government doesn't really want this is also being quite evident in the development in the spreads that we have seen over the summer, because basically what happened is that as spreads increased in July, there came a point when they were really kind of getting fairly high, when the government stepped in with a flurry of activity, and basically they cut the triple R requirement for the banks, so basically freeing up more lending for the banking sector. They flooded the market with liquidity, and they through their medium-term lending facility, and they kind of set loose $74 billion. And they also push back on some of the financial regulations that are coming into place. So all these to kind of ease for the private sector companies. And this softer monetary policy that we're seeing coming out of PBOC is in contrast with the monetary policy of other emerging markets, which are more kind of following the Fed on the hiking path. And what we've seen in China is also signals that the fiscal policy is to be softening. So all these kind of signals that the government is very well aware of the liquidity squeeze for these companies and is stepping in to help them. So basically the situation which we are seeing in China right now is basically the government really walking a tightrope between, on the one hand, longer term financial stability and lower leverage and market pricing, and on the other hand, short term stability and growth. And that is why we don't see that they will allow this default wave, because that would, short-term stability would not be very well served by having mass employment and instability and spooking your credit markets.